Okay, everyone, we'll go ahead and get started with our webinar today. My name is Alex Oliver, and I'm a financial planner with First National Corporation. Today, we'll be going over our webinar, Budgeting for Primary and Vacation Homes and a Balanced Financial Plan. This is a really more common conversation here in 2021. As we've had COVID-19, I've had a lot of conversations with my own clients about fitting in either a new primary home as they've changed geographic locations as their work has allowed them to do that, or if they've been spending a lot of time in the city, maybe finding a new vacation home to be able to escape to as we've been under this quarantine. So it's just been a really common conversation. I'm excited to be talking to you about this and offer my perspective on this conversation, hopefully give you some different data points and maybe philosophical ways to think about how real estate is going to fit into your financial plan based on other priorities that you may have. And so this webinar today, I want to give you a high level view of how I do that. I'll show you the software that I use to help look at these plans. And hopefully, as you talk to your family and consider what you're going to be doing with your real estate, maybe just give you some ideas as to how to start that conversation before you actually get really into the weeds of the financials and how that will occur. So, this is part of our financial bootcamp series with Schwartz & Schwartz Accountants. I think I've been doing these now for about 3 years with Schwartz & Schwartz. Really great relationship with them. And we always do these during the tax season because now is the time when a lot of people are thinking about their finances as they get their tax returns ready to be prepared. And so, beyond what lands on the tax return, I try to come in and maybe give a more proactive approach to, what we should be doing around your tax return. And, the financial plan obviously plays a big part in that, whether you should be saving for retirement, saving for college education, all those things are a conversation to be had with a financial planner like myself, which then leads into your conversations with your CPA. So just as a brief introduction, if you haven't heard about us, we're a registered investment advisor based in the South Shore in Rockland, Massachusetts. We have a wealth management side, which is where I primarily spend my time, obviously why I'm doing this presentation today, where I work with a set of families and manage their investments and get those geared toward their financial plan. Also work with some retirement plans, and we have another side of our practice that does that extensively, working with 401ks, 403b plans, cash balance plans for a series of business owners. And in both cases, we act as the fiduciary provider for our clients, meaning that we have no conflicts of interest here. We don't have any products to sell. We don't have any investments to sell. We're a completely independent company when we manage wealth management assets. That could be at Charles Schwab or Fidelity. If we're managing a 401k, it could be at anywhere between 15 and 20 different providers that we work with right now, whether that's Empower Retirement, Mass Mutual, T. Rowe Price, etc. So we get added to make sure we're making the best decisions on our clients' behalf. So this is the third installment. We did an investment vision for 2021 back in January. In February, we talked about socially responsible investments. And today, again, we're going over vacation homes and primary homes. And then next month, we'll be going over the first million is the hardest, how envisioning the long term helps you today. If you like today's webinar, I think you'll really like that one because that will really go into an extensive detail how I envision a financial plan and how it all comes together over your entire life from ages 30 through ages 90, how that's going to play out. And that might even affect some of the things that we're going to be talking about today that we won't get to today. We're not going to go into that much detail on that end of things, but I'd encourage you to join that. And you can do that by going to schwartzaccountants.com/events and registering for that webinar. If you can't make that specific time, you will get emailed a recording of that. And just so you're aware, the schwartzaccountants.com website also has all of our videos that we've ever done uploaded there. Julianne at Schwartz & Schwartz has done a great job with formatting this and making this look great. So you can go right into the category that you're interested in, whether it's retirement or savings or the overall economy, taxes, payroll, all that can be found at this educational videos website. And just to kind of give you a little idea as to the various different topics we've talked about, I try to come up with 4 to 6 new topics a year. So I feel like I've covered most of this, all the way from the big things like how to fire, strategies for becoming financially independent, retiring early, down to the really specifics like health savings accounts, and just everywhere in between. College student loans, for example, taxes, obviously, with our relationship with Schwartz & Schwartz, a lot to talk about there. So I'd encourage checking those out over a glass of wine and really enjoying some financial education there. So as always have to make sure I just give this disclaimer that anything I talk about today should not be taken as financial advice. Every financial plan I write is different, regardless of even if two couples have the same income and same assets, we all have different financial scripts, different ideas that, we're either comfortable with or not comfortable with. So this should be looked at as entertainment more than advice. And any specific advice, you want to make sure you talk to your specific advisor about. So to lead off our conversation, big picture here, what I want to make sure I acknowledge, and I've heard somebody say this before, I think is really true, financial planning involves acknowledging that you have enough to do anything that you want, but not everything. And so typically the clients that I'm working with, they went to school for a very long time. A lot of my clients are in the medical profession. They have high incomes. They may have student loans that they're dealing with there, but they are in a comfortable position where they're saving for retirement, they're saving for college, they have extra money that they maybe want to put somewhere else. But I have yet to meet a client yet that with every category that we could think about, they could accomplish anything that they ever wanted to do. Usually we have choices to make, and that's okay. A lot of this webinar today is going to be talking about how real estate fits into your portfolio and how much of an emphasis you want to put on that. There are people that, and maybe some people like this, that really don't really care about their real estate whatsoever. They may have a very inexpensive home and spend their time and money traveling, or maybe they spend their money, putting their kids through very expensive colleges. And so I just want to make sure I acknowledge that, because again, obviously today we're going to specifically talk about real estate and how that fits into the financial plan. But there's just various different categories that you could be focusing on in a financial plan. And if we are going to focus a lot of our time and money into a primary home and a vacation home, it's very likely we're going to sacrifice something else unless we can get a little creative, which we will talk about toward the end of this presentation. But when I go through a financial plan, these categories usually boil down to retirement, real estate, children's education costs, parents' long-term care costs, vacations, hobbies, and then automobiles, less or so on the bottom category, bottom half of the screen here. But I wanted to outline it because as you talk to your family about what your priorities should be, what I've done is sort of highlighted in green what would be relatively easy to accomplish, what wouldn't really cost a lot of money to make sure it happened. So for instance, if you have a job that is not very demanding and you love working at, working till age 70 means that you'll have money for other things. Creative passive income that will allow you to do other things as well. But if you want to become financially independent and retire at age 50, that's why we've highlighted that in red. That's obviously going to cost a lot of money. When you think about living from ages 50 through ages 90, we need to make sure we save a lot here. So if that was your priority, you'd put a lot of money in this bucket and then maybe not so much in the real estate bucket. Real estate, we could talk about having a very cozy and rural home, a relatively smaller home, or going into a great school district with an in-law suite. And then today's topic, again, obviously talking about 1, 2, 3 different properties. That's obviously going to be a little bit of a harder thing to accomplish. Children's education costs, you need to have a philosophical conversation here. Maybe we're willing to pay for our child's in-state tuition at UMass Amherst and then, put our money elsewhere for our own needs. Or maybe you've made the decision, we'll pay for the best university that our child can get into. So if they want to go to Tufts University and they also want to do grad school after that, and we want them to walk out without any debt, so that way they can get started with their own career, again, obviously we're pulling money from other parts of the plan to do that. Parents' long-term care costs, this is a hard one. Nobody really wants to talk about this necessarily, but it's a realistic one that we all have to make sure we talk about. If your parents are still living, are they financially independent? Will they be able to take care of themselves when they get into their late 80s or early 90s? Or will you need to help out? Do you have other siblings that can help with this financial burden? Or are you the sibling that has all the money and that will actually have to take this on yourself? So maybe that has to be budgeted in here. Vacations, if you want to take road trips to national parks, that'll be very cheap and inexpensive. But if you're going on African safaris every year or even twice a year or something like that, that's going to be very expensive. Hobbies, again, there's cheap hobbies, there's very expensive hobbies. Automobiles, there's cheap automobiles, there's very expensive automobiles. So as we go through the real estate conversation today, I just want to make sure we acknowledge all of that. to say, how can we make our entire financial plan work? I'm guessing if you're attending this webinar today, real estate is something that's relatively important to you. Having a comfortable home, maybe a good school district, having a vacation home that you can visit frequently and enjoy. So we want to make sure we can find a way to make that work for you. So little rules of thumb here as you're thinking about your own budget to go through. I just want to make sure I bring this to your attention that when a lender is going to give you a mortgage, usually they're going to tell you that you can spend no more than 28% of your gross monthly income on housing expenses. So this would be a combined amount of mortgage and rent, homeowners association fees, property taxes, things of that nature. And then if you have a lot of student debt, the lender is not going to want to see that total debt payment exceed 36% of your gross income. So this would be things like student loans and car loans. So to break that down into what that would mean for you, this just goes over a couple earning $200,000. Let's just say they had no debt in our first scenario. These people could spend $56,000 per year from the lender's perspective on annual housing expenses. So the lender basically would say that this should be enough amount of money that even if you had, some small emergencies along the way, you should still be able to afford this amount, the $46.67 per month. And just going on Redfin and looking at, different property taxes, I just picked Waltham, Massachusetts, a suburb here of Boston, basically to say that this couple right here could buy a $1 million home, 20% down payment with a 30-year mortgage at 3.5%. Obviously, interest rates are really low right now in 2021, and which is why this is a really hot topic for people in the last couple of years. Now, that same couple with the same income, if they also had $3,000 a month in combined student loan payments, well, they're a little bit more limited in what they're going to be able to do for housing expenses, because now with that 36% figure, we're at more like $3,000 per month, which is about a $650,000 home in Waltham. So that, I think, when you're thinking about whether you have your primary home already and you're thinking about adding that second property, keep this rule in mind, the 28% and 36%, as you start to think about, if I want to buy my home in Florida or get a ski condo, just as at a high level, what could I afford? Keep that in mind. But I've also just noted here down below that I typically see that my clients, their total housing payments are usually in the 17 to 22% figure. So definitely not close to that 28% that the lender is going to allow you to have. Most of my clients, real estate's important, but they've also got other priorities. So we've usually kept housing costs in that range. And then that usually goes down because my clients' incomes usually are going up year after year after year. So just something to keep in mind here. This is actually one reason too when I might advocate a fixed rate mortgage versus an adjustable rate, because again, we would know exactly where you stood from a budgetary standpoint and for the financial plan, and interest rates are just really low right now. So that in many cases is what's going to make a lot of sense. Okay. Before we go too deep into this conversation, as you start to think about your primary home or your vacation home, I would turn your attention to a calculator that I refer my clients to all the time, which is a New York Times buy versus rent calculator. Sometimes it'll block you if you don't have a New York Times subscription. So just open that up in an incognito window, and you're going to be able to get access to this calculator. But what it does is you can take a house that you're thinking about and input all the variables. My screenshot can't capture all the variables that go along this, but it'll ask you for things like the property taxes, what you think your maintenance costs will be, the cost to buy and sell the home, for example. All that will come into this New York Times calculator and then tell you if you can rent a similar home for less than X, then renting is actually better. So the reason I'm bringing this up now is because if you're thinking about a vacation house, just as an example, you really have to start to think about like how often you're going to end up visiting that vacation home versus, whether you just don't buy and just rent Airbnbs and how much you're going to spend on that. Or in the sense of a primary home, this example is actually a client that I'm working with. They've moved across the country and they're thinking about buying a house, but they're new to the area. And so what I've kind of told them is that if you're going to buy a house, you really should be pretty confident that you're going to stay there for at least 5 years, because there's a lot of costs that go into buying and selling a house. And if they stay there for only 2 or 3 years and they buy a new house, financially, it's probably not going to make sense. And what this New York Times calculator does is it actually tells us, with all the other variables that we've entered in, if they were to stay here for 5 years, if they could have rented a house for less than $3,500 per month, they would have been better off. So that's one of our projects right now, is to figure out what are the housing rentals versus buying a house, and kind of see a break-even point from that perspective. But go visit that New York Times calculator when you're evaluating properties. I do it with every property that I consider, and I think will help give you some perspective on keeping that property for a long time and making sure it's worthwhile. Okay, so let's go through this. We're going to talk about primary homes and vacation homes. So let's start with the primary home topic. I have here that an average American might own 3 homes in their life: the late 20s starter home, the family home that increases space and considers school districts, and then the empty nester condo. As soon as I read that out loud, it's one of those things where I say, yeah, sure, maybe for some people, but for other people, because their financial situation changes, either better for worse, or their job situation changes, or they want a different school district. I know that in reality, you're probably going to end up owning more than 3 primary homes, but this is maybe an average American again. And I bring this up too because if you were to fall into this bucket, it does help you with more stability. The longer you're going to stay in these houses, the better your financial plan is going to be, the more stable it's going to be. Because just as an example, we could look at that home, that second home that you're going to look at, the family home that increases space and considers school districts. This might be a pretty expensive home. If you've got 3 or 4 children and you need bedrooms for all those children, again, that could obviously be a pretty expensive home until your youngest child gets to be 18 or 22 years old and they've gone and left the nest. You might downsize from this $1 million or $2 million property down to a condo that just has, 2 or 3 bedrooms, and maybe it's in a much lower cost of living area. That frees up liquidity to go to the rest of your financial plan, or have a vacation home, for example. If the kids want to visit, you get them a nice Airbnb nearby, and that's perfectly reasonable. But the more you can kind of solidify what your primary home situation is going to be, the better off our plan is going to be. So considering any job transfers, whether you're going to have in-laws move in eventually, and whether that means you're going to have an addition on the house or build another structure nearby, or if you just buy something in your same neighborhood, these are all things that really need to be considered when you're thinking about that primary home. Okay. So before getting to the vacation house conversation, I want to make sure I really bring up those points. As we go through our examples, I want to make sure I go through one that's, I think, really real. So we're going to talk about Frank and Joanna. Frank is 56 years old. Joanna is 55. They've got 3 children, 26, 23, and 22. They also each have a mother that's still alive, 86 and 83, that we might need to financially support. So we're going to go through some different scenarios of what they can make possible and what they can't. They're going to have a primary home that's $850,000 with a $400,000 mortgage. They've got a vacation mountain home right now with no mortgage on it, and we're trying to figure out what to do with that. Because at the moment, they're maxing out retirement plans, they're contributing to an investment account. They'd like to retire at ages 62 and 61 and live off $120,000 per year. And so we're going to see if we can make that happen. Our base plan, though, actually runs out of money at ages 90 and 89 on a linear basis. So if the accounts just earn 5% per year, they are going to run out of money at this age. And then when we put this financial plan through what's called a Monte Carlo analysis, it gives us a 13% probability of success. So if you haven't heard this term before, Monte Carlo analysis basically is our lingo to put your financial plan through 1,000 stock market simulations. That way you can see how your plan is going to look over the next 20 or 30 years. And let's talk about the scenario where if you retire and we have a 1927 Great Depression and your stocks take a big hit early in retirement, are you still going to make it? What is the percent probability that will actually happen based on 150 years of stock market history? So that really keeps us honest to be sure that we're in a very solid spot, even if the other areas that we can't control are negatively affecting us. Okay. So again, this base plan right now, retiring at 62 and 61, it's just not going to work. we usually want this probability to be upwards of 85, 90, or 95% probability of success. Once we're that high, we can make small adjustments to make sure we get there. But at 13% probability, nobody's going to be happy with that kind of a plan. So I'm going to give you some screenshots now of what we call our wealth management system. This is where we have our financial plans internally written, and all of the details that I just outlined for you on that last screen are built in the background here. And so all of the tax implications, the cash flow implications, the investment returns are all happening in the background. And if you're ever a client of mine, I'll go through those with you. But for now, we can go through just a high level idea as to how this financial plan would look. No surprise that, again, they're in their mid 50s. If they start accumulating money till they retire here at age 62, and then they're going to start withdrawing money from their retirements over time, as I mentioned earlier, currently they do end up running out of money in 2054 at ages 90 and 89. So we need to make some changes to the financial plan. On the left-hand side, we have all sorts of different scenarios that once I've built this out, we can just switch on and off to see how it's going to affect the plan. So again, this plan doesn't work right now, but if we go to our next screen, our first scenario would be just involving downsizing their primary home. So as I mentioned before, if you're in that great school district right now, you're not going to need that once your children are out of school. So maybe you sell your primary home for $850,000 and you buy a condo in Florida for $400,000. The big thing in retirement is obviously liquidity. You need to actively be able to withdraw these assets to live off of. And so what we see here is at that time, I think I've timed the sale of the house for right when they retire. They're going to have some extra money in their retirement accounts. That's our green here. And we actually do end up with money still at the end of the plan. In 2059, we still have about $1.5 million of assets to be able to work with. So at first glance, that's actually a pretty good solution that we've added there. Made actually a really big difference for the plan. But if we go to our next screen, I just want to bring in that Monte Carlo analysis again, because this will tell us that running our financial plan through those stock market simulations, we're only going to now have a 42% probability of success versus 13% from where we were before. So we've improved, but we're not quite there yet. As you can see here, our red is going to be 0 to 69, yellow 70 to 81, and then we really want to end up in this green area, 82 to 100%. So we still got some work to do with Frank and Joanna. How are we going to make their financial plan work? Well, beyond, I guess one last thing I'll just show you here just to make sure you understand the Monte Carlo is that this is the spread of how your assets could end up on this plan. And so talking about above average stock markets and below average stock markets, the below average, you can see we start to run out of money in some of these scenarios. There are some upside scenarios which bring us way more money than we needed. But on the median case, we're pretty close to the end here. That's why that number came in at 43%. So let's try some different things here. Now we're going to throw in another scenario where we say we're going to retire 3 years later. So now at ages 65 and 64. So maybe they, again, they don't want to sell the vacation house. They're okay with downsizing, but we've moved our retirement date 3 years later. They're okay with staying in their jobs right now. And now you can see the green is way up. We don't really have a decline in assets, again, on a linear basis. And as we continue to move along here, you can see that our Monte Carlo analysis put us at a 92% rate of success. So that plan right there, if this was a new client of mine and this is everything we needed to know, I'd say this is a pretty good situation. You sell your primary home at some point in retirement, you downsize, that gives you that extra $400,000. You retire 3 years later, we've got a great financial plan. You're good to go here, okay? Now, again, we haven't even sold the vacation house. We haven't done anything with that yet. So they get to go into retirement still having that. But, now we're going to talk about whether we want to keep it or not or for how long. So, that vacation house that you're thinking about, I probably don't have to tell you this again, but how often you visit the property is going to be very important. If you live in Massachusetts and you've got that ski condo in southern New Hampshire, that's pretty easy to get to every weekend. If you're going every weekend, and your children are in ski school and you're doing that trip every Friday or every Thursday, going to probably be a good bang for your buck. If that vacation property is in Florida or Arizona and you only go there 4 times a year, the financials of that are not going to make a lot of sense. So how much would a season of Airbnbs or rentals cost you? You need to make sure you research that, get those data points to figure out a break-even analysis there. As I mentioned before, would you hold the property for at least 5 years? 5 years, whenever I do this analysis from my client, seems to be pretty close to what the break-even point would be versus just renting otherwise. Um, there are some areas in the country where the property prices are actually quite low and the rentals are quite high. And Florida is the first one that comes to mind there. But then there are other parts of the country, like obviously New York City or Los Angeles, where the real estate prices are actually quite high compared to what you can actually rent for. So that is where that New York Times calculator really comes into play here, where you can start to get a break-even analysis. Could this could this vacation home actually end up being your retirement home? Well, that really helps your financial plan, because if this is, a mountainside cabin in New Hampshire that you use as your ski condo, for example, and you're going to eventually just sell your primary home altogether and move here, well, that could be part of the financial plan too, making this your primary residence. Is it realistic that this would be your retirement home? Especially when you're 80s and you're not wanting to climb a lot of stairs anymore, or drive up that mountain, for example. That might not be the case. So it's obviously going to be dependent on where we're talking about for this retirement home. Would you foresee generating income through short-term rentals? So we'll talk about this here, and we'll talk about how this fits into our financial plan. But if you're willing to go through the work of listing this on VRBO or Airbnb and generate a little bit of income, this could make it more feasible that you're going to keep this for yourself. And maybe you only end up using it for, let's just say 60 days out of the year, but there's another 305 days there that potentially could bring in rental income. Philosophically, whether you're willing to do that work or take that risk or have somebody come in and use all of your personal things while you're not there, that's a conversation you got to have, but it could make these financial plans a little bit easier to accomplish. And then finally, would a timeshare or other flexible arrangement be a better fit? So if you buy the vacation property, is it a location that you're going to be excited about going to year after year for the next 5 or 10 years? Or would you like to change it up and go to other geographic locations? So a lot to consider there as you're going down the vacation home discussion point. But now I just want to go and talk about Frank and Joanna again and just see how this is all gonna line up. So here, what I've done is we've gone back to our base facts, but we're going to retire 3 years later. In this case, we're not selling the primary home just yet. So the only scenario we have here is just retiring 3 years later. But again, we're not quite there yet. We're at a 69% probability of success. So something's got to happen to be able to make this plan work. So now they've decided that they're actually going to sell that vacation house. And this is not only going to give them the $350,000 from netting the property. Just remember, they don't have a mortgage anymore. But we're also going to lower our annual expenses by $15,000 because we're not paying for property taxes or maintenance anymore. So this gives us a 98% probability of success. So inevitably, then the conversation is going to be, what will we use that money for? And in their case, there may be some desires to take special vacations around the world. And so we've got $30,000 from ages 65 to 75 earmarked specifically for those vacations. But then we also are considering those mothers who both might need some financial support, maybe through long-term care, for example, like a home health aide. We're going to set aside some money here so that we know we've got that taken care of. And now we're in the yellow. We're in a 75% probability of success there. So again, if it was my client, we'd want to make some changes, but not too many, because we are in the ballpark of making this work. So again, they've decided now they don't need that vacation house. They'll travel. Now we've got our moms taken care of there. This is a plan that we're happy with. Or maybe instead, we still have to take care of our mothers, but we're going to be now putting our vacation home up for Airbnb rentals. So now what I've done is I've generated $28,000 of income on a net basis after all of our expenses. And so every year, hopefully we can count on renting this out for a net of $28,000. And that's going to help out our plan immensely. So we keep the vacation home, we help our mothers, and now we're going to be able to have a 96% probability of success, because as you can imagine, having that steady income, in this case, we're generating 8% from our vacation home, is going to give us a lot of flexibility, because the vacation home itself might also be increasing in value as well if we do want to sell that down the road. Okay. So, how do we think about that? How do I think about like how a rental might play into play for you here? Rental income really should be exceeding at least 5% net of what you could sell the property for that to really make sense from a financial perspective. So where does 5% come from? When I manage a liquid portfolio, whether that's an IRA or a Roth IRA or an investment account, that's usually what I tell my clients that they could count on for annual retirement income. And that's our goal with the account, is to get them about a 5% rate of return over the long haul. So if I've got $1 million in an IRA and it generates $50,000 worth of income, hopefully it also is generating $50,000 of investment returns, and we sort of end the year at that $1 million mark. If your rental income is less than this, then you're probably better off selling the property and just putting it into investments, whether that's stocks, bonds, or even real estate investment trusts that could get you that sort of rate of return. So you'll have to look at your area. You'll have to see what you can get for rental income. This is definitely based on geography, because again, there are places where you can buy very cheap properties and charge a great deal of money from the renters that are coming around, especially if these are high destination places in seasonal areas. Just remember that economic recessions can certainly affect your projections. We've obviously seen this through 2020 with people that had rental properties, both on the bad side and the good side, right? Because there have been people that couldn't travel to more exotic places, but maybe your Airbnb that was only an hour outside of Massachusetts actually was fully booked this summer because there was nowhere else for people to go. So you want to make sure you kind of consider the downside and the upside for these rental incomes. Depending on how active you want to be, you want to make sure you factor in property management expenses if you're going to be distant from this area, or as you age and are no longer to do this anymore. Usually a property management company can help you to list and book this yourself. And then there is a tax consideration here that might help you, especially if you're still working. So short-term rentals allow for a deduction of depreciation losses against your W-2 income. When you do long-term stays, if you're renting on a monthly basis, you can only do that when you achieve what's called real estate professional status. But if you're just doing Airbnbs for a weekend, and you're a doctor at a hospital, some of these depreciation of your property at $350,000 mountain home, you can depreciate down and bring your tax bill down. Now, there may be a recapture expense on the other end of it when you do sell, but if the intention is to keep this vacation home and keep it in the family and leave it to your children, you'll actually get a step up in basis at that time and completely avoid the recapture of that depreciation costs. So that's an area where having these properties might actually be very beneficial to you if you're in a very high income tax bracket, and you can generate some short-term rental income from that. You can lower your tax bill, have a vacation home to visit, generate some income on top of that, and now the break-even point here is actually a lot closer than maybe you would have otherwise realized. So if you are working with Schwartz and Schwartz, that'd be a conversation to bring up to them and how a rental might affect your tax situation. And that's where, again, my job at First National Corporation to kind of create the whole financial plan and then see where we can help you with taxes. That's why we've got this really nice relationship with Schwartz and Schwartz, so we can go back and forth on these kinds of conversations. Okay, so again, I know this is a kind of a high level, just general conversation, because it's just really tough to give very specific information without going into the idea, the specifics of what area you're going to be buying this home in and what other considerations you might have on your balance sheet for income or liabilities. So, hopefully this is at least giving you some ideas and some new ways to think about it. But I'll just kind of go back to this slide one more time, saying that, financial planning involves acknowledging you have enough to do anything you want, but not everything. But now I've asterisked this and just said without a plan, because I have a lot of fun just drawing up these plans and trying to get creative. I have the benefit of working with several families and seeing the ways that they've done it, seeing what's worked and what hasn't worked. And in most cases, we can find some scenario that's going to leave you very happy, balancing all those priorities that we talked about before. So at the end of the day, it just takes sitting down and thinking about it. But if you're attending this webinar, I think you know that already. You wouldn't be the kind of person that just goes out and buys the property and tries to figure it out. If you could go into that purchase knowing I'm going to own this for 10 years and then sell it for my retirement plan, it just makes the decision much easier to come to. So I'd encourage, if you're thinking about this, feel free to reach out and we can certainly talk about your situation more specifically and try to get a plan in place. So if you'd like more information on our firm, fncadvisor.com is our website. A lot of great resources here. And specifically, if you're a dentist, I'd encourage you to click this tab here where I've got a free ebook that you can sign up for just by putting your email address in. You'll get a Kindle version of that to whip through some of the basics here if you're a younger dentist, some of the more specifics to your industry in this area, and then obviously as you're going into retirement, how that might look. Even if you're not a dentist, feel free to request that. A lot of good information in here to kind of leave you with the basics of constructing a financial plan. But as I mentioned, if you'd like more information from us, fncadvisor.com, our blog here is where I'll write some different articles, including topics like these. My LinkedIn, feel free to connect there, and I like to share different articles that I see on that site. And then my email, alex@fncadvisor.com, if you want to contact me directly with any questions. Okay, so I hope this was helpful. Thanks for joining us for our third webinar here today, and I hope to see you next month for our last installment. Take care. Have a good one, everybody.